Good afternoon, and welcome to the Center for Disaster Philanthropy webinar, Insurance and Mother Nature. How does losing insurance options affect disaster philanthropy? My name is Carrie Cullen, and my pronouns are she, her. I'm the director of the CDP's Midwest Early Recovery Fund, where I focus my work as part of the fund's management and coalition building team on supporting rural communities after low attention disasters through funding, expertise, and connection. In my other past roles, I have served as a disaster case manager, statewide recovery coordinator, and project manager for the Midwest Consortium for Disaster Services. Through these experiences, I have developed expertise in post-disaster children's needs, disaster case management, spiritual and emotional care, mid to long-term disaster recovery, rural recovery, and community needs assessment. A few housekeeping notes before we get started. You can submit questions at any time during the webinar using the Q&A box at the bottom of your screen, and we will answer them at the end of the panel presentation. At the end of the webinar, there'll be a short survey. Please complete this to help us improve our webinar offerings to meet your needs better. And finally, we are recording this webinar. It will be available on our website and YouTube channel shortly after the webinar is complete. Live captioning is available now via Zoom. Click on closed caption live transcript to access it. You can also access it in languages other than English. This webinar is co-sponsored by Giving Compass, Philanthropy California, and Philanthropy New York, and we'd like to thank them for their support. As we begin the webinar, CDP acknowledges that it works on the stolen lands of the many original peoples. We recognize that Indigenous peoples have been displaced and disenfranchised from their land by the socioeconomic and cultural impacts of colonialism and disasters. The erasure of Indigenous knowledge about how to care for these lands has caused environmental destruction and degradation. CDP is committed to dismantling the ongoing legacies, systems, and structures of settler colonialism and white supremacy and their connections to philanthropy today and in the future. Despite centuries of theft, violence, and murder, this still and always will be Indigenous land. Please join us in acknowledging the original peoples and their elders, and the past, present, and future generations. At the end of the webinar, donors will draw a link between the climate crisis and insurance-related housing unaffordability, understand how the insurance crisis affects individuals, especially in disaster-prone states, explore a suite of ideas to assist homeowners and renters, and understand the role of funders in helping to implement them. So now we're going to take a look at the results of our poll. And so the first question, have you personally or anyone you know been affected by the rising insurance costs or insurance companies withdrawing from the market? And I think as we probably anticipated, a lot of you yourself or someone that you know has been impacted by that. We were just chatting briefly before we started the webinar that we are seeing that even more and more on the increase in the news. And we're seeing it increase even in spaces where we thought perhaps there was a little to no risk of that happening. So it definitely is on the rise. And the second question, does your organization address issues of insurance affordability? I think, seeing kind of the split and the division around this is really why we're having this topic in this webinar as we're thinking about that, right? It's a topic that's critical to the idea of disaster philanthropy and to thinking about equitable recovery. And yet it's hard for a lot of us to think about is it part of our work? How do we do that work? We're unsure about it. We have questions where it is. And yet it's exciting to see for some of you that it's a focus of the work or that you're interested in what that is. So I look forward to the conversation today, and hopefully from that, it will spark additional ideas and conversations to move us forward. So before we introduce our speakers today, I did want to give a little bit of context and background to the topic at hand. So there are many communities across the United States and indeed the world that struggle to access adequate home insurance. For the past several years across the country, homeowners and to a lesser extent renters and business owners have been facing the news that one insurance company after another needed to stop their homeowner lines of insurance, especially in disaster-prone states. In 2023, there were $28 billion climate and weather disasters in the United States. Climate change means that this number is likely to stay high. The Insurance Industry Association recently said, as risk increases, so does the cost of insuring assets that people have on hand. The impact and withdrawal of these companies and the associated increase in price for homeowners are illustrated on this slide. In the top two boxes, you can see the kinds of notices that many homeowners across the country have received. Our example here is a 55-year-old woman who runs her own business. She bought a 2-unit home in Southeast Louisiana in 2014. She mitigated her property and managed to cut her flood insurance by 50% in early 2017. But when we look at her flood and hazard insurance combined from 2017 to 2024, we see an increase of nearly $4,500 a year, or almost $400 a month. Her taxes have also gone up by $100 a month, in part because the number of disasters in her community has experienced. So within a 6-year time period, her insurance and tax has risen almost $500 a month, which is also outpricing new people trying to enter the market in this area. This is just one example, and it's not that extreme. Homeownership is becoming unaffordable in large part because of the cost of insurance, which then impacts housing affordability overall. We know that with insurance, people tend to recover faster than those without. And ultimately, the community recovers faster at large. However, understanding the role of insurance and a clear path forward in our increasing disaster-prone world is challenging and critical. Now, it's my honor to introduce our special guests, and I am looking forward to the information that they will share with us. Amy Bach is a nationally recognized expert on property insurance and disaster recovery. Bach is the co-founder and executive director at United Policyholders. She is an official consumer representative at the National Association of Insurance Commissioners. United Policyholders is also a CDP grantee partner for both their Roadmap to Recovery program and their Advocacy to End Action program. And Dr. Carolyn Kuski is Associate Vice President for Economics and Policy at the Environmental Defense Fund and author of the book, Understanding Disaster Insurance, New Tools for a More Resilient Future. She is Vice Chair of the California Climate Insurance Working Group. Both Amy and Carolyn serve on the Federal Advisory Committee on Insurance at the U.S. Department of Treasury. I'm pleased to speak with both of you today, and I really appreciate you taking the time to share your expertise with us. So we're going to start with you, Carolyn, and just ask for you to give us a lay of the land on the insurance industry right now, and why does it seem so bad for those of us who are lay people in this world?
Yeah, thank you. Happy to kick us off, and thank you so much for the invitation to have Amy and I here to chat with you about this important topic. So the last few years, there's really been a confluence of events in property insurance markets that have been rising prices and decreasing availability of cover. There are a few contributing factors, including higher costs of rebuilding, but a big driver, as you mentioned, is the growing risk of weather-related extremes. And that's both sort of big events like hurricanes and wildfires, but it's also just events like worse thunderstorms and worse hail. I want to start by noting that disasters have always been difficult for the private sector to insure, and we've had public interventions in these markets going back decades and decades because of this. When events happen where everybody gets hit at the same time and it can be really bad, it violates the nice mathematical laws that make insurance work and that create benefits from risk pooling. And so now, as climate risks accelerate, we're seeing that some risks, which were once less common, are starting to become too frequent to insure affordably, and others are becoming too big to insure affordably. So climate is really driving losses from these events so high to a place where it might be the case that insurers can't offer policies at prices that households or businesses can afford or are willing to pay. So what are the types of trends we're seeing right now? To kind of get back to your question, the first, I want to highlight 4 things. The first is bankruptcies. And this is a little bit localized, but we're seeing, a dozen insurers in Louisiana have gone bankrupt the last few years. Florida 5 were liquidated in 2022, another in 2023. The second, which you mentioned, is escalating prices around the country. And prices are up everywhere because of these other costs of driving up the cost of rebuilding from prior period of inflation and supply chain disruptions and labor shortages. But in hotspots of climate risk, we're seeing particularly high premium increases. The third is insurers pulling out of markets. And so that's things like the news headlines when State Farm and Allstate left California. They are leaving Louisiana. They left Florida years ago, most of them already. And when insurers aren't leaving entire states, we're seeing them reduce coverage they offer in certain regions, like maybe high-risk zip codes or along the coast. And then we're also seeing them sort of pull back the amount of coverage they offer in their policies. And I think that's something Amy could probably provide some more insight on. And then finally, the last trend to note is that all of these things are leading to a migration of risk from the private sector into our public sector programs. So every state at high risk from climate disasters has a state level program. So like the FAIR Plan in California to provide wildfire coverage, and enrollment in that program has more than doubled since 2018. In Louisiana's program to provide wind coverage from hurricanes, policies in their program have tripled since Hurricane Laura in 2020. In Florida, the state program's seen a growth of over 200% since its low point in 2018. I think there's now like in excess of 1.3 million policies in their program, and they're the largest insurer in the state. And this creates a whole bunch of other risks because some of these programs weren't designed to assume that much risk, and that can create fiscal risks for the state and taxpayers.
Thank you for explaining and outlining those that so well. In our planning call, we were talking about the fact that insurers are companies; they're running a business. And you talked about that during the wildfire season in California in 2017 and 2018. There was the entire homeowners insurance market in that state paid out more than twice of 30 years cumulative profit. So about 60 years of loss for profit in 2 years. Can you expand on that or maybe help me understand that a little bit more, what we were chatting about?
Yeah, that's an analysis from the actuarial consulting firm Milliman. And I think it really stresses one of the challenges here with these growing climate disasters, which is that growing extremes is really upsetting our traditional models of pooling risk and insuring risk. And there are some reforms we can make along the edges to reform these markets, and we should make those. But I think that statistic and others really stress that, in my opinion, the only way to really stabilize these markets in the longer term is really transformative investments in risk reduction and actually bringing down the risks that people face, because only when the risk is lower can we lower the cost of risk transfer, whether in public sector programs or the private market. And so similarly, I think there's reforms to these public sector programs I was talking about, especially to do things like help lower income residents and drive more investments in risk reduction. And that last one is, I think, the really important thing, and that we should be sort of interpreting what we're seeing in the markets right now as a warning sign that risks are getting really high.
Great, thank you. Amy, I want to just turn to you next. Can you tell us about the work of United policyholders and how you work from preparedness to recovery in the disaster setting?
Sure, thank you. And again, very pleased to be on the panel and really grateful for CDP for focusing on this really critical issue, especially for funders that want to help improve disaster recovery. This is ground zero right now. So United policyholders started right around the time of a major wildfire. It was an urban area wildfire in 1991 in the Oakland Berkeley Hills. And our original programming was to offer classes, basically meetings, classes, clinics, resources to help the households who had lost their homes navigate the insurance claim process and collect every dime that was available to them under their policies. And we built partnerships with volunteer lawyers, the Department of Insurance, local builders, and we provided a spectrum of support and guidance. And that program that we built way back then, almost 33 years ago, we continue to refine to this day. And so for many, many years, we were focused very much on telling disaster impacted households what's up, which way should you go, helping them make these really hard decisions. Do I want to stay? Do I want to rebuild? Do I want to move? Do I want to sell my lot? And we found very early on that people had insurance gaps. And so we started to build a separate program called the Roadmap to Preparedness, through which we take lessons people learn the hard way after disasters about things they wish they had done. I wish I had an itemized inventory. I wish I had all my documents in one place. I wish I had fine-tuned my insurance after I did this addition, or after I bought some kind of valuable item that I didn't insure. And so we developed a program where we will go into communities and we develop print materials and digital and videos to try to get people to pay attention to a topic that people don't really want to think about. And that's kind of the overall thing these days, right? Is we say to people, sorry, you're going to have to think a lot more about insurance than you ever wanted to or thought you would have to. And we know it's not anything people are enthusiastic about spending money on. But it has been our work for many, many years to use disaster survivors. People don't like to be called victims, as disaster survivors, as messengers, because to say, well, I'm here to help you avoid some of the pitfalls that I had to deal with. And we're really, think about your insurance now, get it where it needs to be, think about it, just put a little bit of your mental energy toward it. And you'll be in a lot better shape if, God forbid, you get hit with a loss. So, we've been doing that work, and it's been increasingly challenging as the options in the marketplace continue to shrink and prices are going up. A lot of our preparedness work was very focused on avoiding being underinsured. But where we are now, and we just hosted a webinar the other night, we had over 1,200 people from California come on a home insurance shopping help webinar. And we got over 200 questions, and people, where we are now is helping people choose often from the least worst option, and looking a lot at, instead of thinking about their insurance should cover everything, every single thing that they might lose, to thinking that they need to just buy the insurance that is most essential. So just like we talked in the Affordable Care Act about essential benefits, right? We want people to have coverage for checkups and preventative care and, all those things. In the context of property insurance, we're thinking a lot about what's adequate, what is the bare, and I hate to even put it in these terms, but like, what's the bare minimum that people really need to keep in place? Because as the stats are showing us, the prices are knocking more and more households out if they've paid for their mortgage, if they paid off their home and they don't have to help carry it. We're seeing more and more households going bare. We're trying to prevent that.
Great, thank you, Amy. I'm sure that the work is both rewarding and quite frustrating at times, as you're sitting with those on both ends of the spectrum with disaster and making these just hard decisions with them. Carolyn, can you tell us a little bit about, you talk about inclusive insurance in your book, and what is it and why don't we have it?
Yeah, happy to talk about that. And I think it helps to maybe quickly remind us why what is happening in insurance markets matters so much. And Amy talked about this, Carrie, you mentioned it at the top with your introductory remarks, but there's a growing body of research now that those households that have insurance recover better, faster, more likely to rebuild faster, have fewer financial burdens, fewer unmet needs. There's nice sociology research that lack of insurance widens income inequality post-disaster. And with colleagues, we found that as there's more insurance within a community, it has positive economic spillovers in terms of increased visitations to local businesses and so on. So it helps jumpstart the whole local economy. So, and we also found that it's protective against delinquencies and defaults in the mortgage market. So it also provides these benefits for lenders and GSEs. So insurance provides all these financial benefits. So a well-functioning insurance market is critical, but we also find in our work that insurance is sometimes failing to deliver on these benefits. And I think right now there's two big issues. One is the climate stress, which we talked about, but the second is sort of equity issues that gets into this concept of inclusive insurance. And we have a growing body of work on this at EDF. And we define inclusive insurance as the sort of suite of programs and policies and products that can provide appropriate and affordable coverage to those who are currently unserved or underserved by the market. And in a framework report we put together on this, we noted that an inclusive insurance system should be affordable, accessible, transparent, people-centered, and just. But we also see there's many barriers in achieving all those outcomes when it comes to disasters. And we've talked about some of them already. So limitations in coverage, sort of lots of exclusions and restrictions on what's covered by your policy. We talked about things just being simply unaffordable at all. But we also saw that beyond that, there are certain types of needs that are not well covered by our existing insurance system and certain populations whose needs are not well met. So for example, one that we've been working on recently is emergency needs post-disaster that happen sort of in the very first hours and days. And a lot of those are non-property losses, which are also not well covered by our traditional property insurance market, right? So when people have to pay for things like evacuation expenses or higher commuting costs or a generator, when the power goes out and those types of things, or renters seeing higher rent. We've also been looking at, and again, this is something Amy might have some insights on, but procedural inequities in all parts of the insurance value chain. So for example, it can be difficult to access a fair claims payout, and we see that that's disproportionately harming households who have lower financial literacy, lower time or income to kind of navigate that process. So we've been looking at a bunch of different policy reforms, both legislative and regulatory, as well as some insurance innovations that could maybe help create a more inclusive system. So these are things like means-tested assistance for flood insurance at the federal level, which has been introduced for like 15 years and Congress has never adopted. Things that would be more state regulator level, like creating baseline coverage standards. Maybe this gets to Amy's concept that she was just talking about, which I thought was really interesting about like, well, what's the kind of necessary things that we need to make sure that everybody has? Reforming those claims contestation procedures to make sure people get fair payouts. And then we've been doing some work on these innovative types of insurance, harnessing parametric models, and maybe we can come back to that one later in the conversation.
Great. Thanks, Carolyn. And I think, yeah, going to you, Amy, on our planning call, and you kind of touched on this. You said your work, you've struggled at United Policyholders for 3 decades with this constant reality that people's insurance does fall short in some way. And Carolyn was just talking about, this lack of meeting needs and, what it needs to look like to be inclusive for all. Talk to us a little bit more about why insurance isn't meeting the current need and maybe what it could do to meet oncoming future needs.
Yeah, I mean, I think that what this current national crisis, affordability and availability of property insurance crisis, is making everybody recognize is that we have been relying on the for-profit sector, on a capital-driven industry for a very essential economic underlayment of our homeownership, of our households' financial security, buying and selling homes, and the mortgage whole ecosystem, and that capital-driven system is going to react to climate change. I don't know that we all we knew that, and it's been predicted that climate change would bring some shifts in the property casualty arena. I think we didn't quite realize how the phenomenon of increasingly frequent convective storms and hail events would, in places that they hadn't been before. We knew how that would affect an insurance executive's decision-making and actuarial predictions, but we didn't realize think about how technology was going to speed up the perception that insurance executives have that maybe insuring real property isn't going to be profitable the way it was, and that they're going to need to shift. So we have a lot of work to do, and there's a lot of people have their sleeves rolled up looking at new options. But the reality is we are still very heavily dependent on both the private reinsurance and insurance sectors. And we really were to develop public nonprofit insurance options. We've got to speed that up as quickly as we can, but there really are not really that many models of it, right? So, and we don't want to we need, of course, the expertise that the private sector, the private insurance sector brings. So we're not trying to squeeze them out. We're just trying to be realistic about how they see what's happening. And the fact that now insurers are using drone images and they're using AI and they had been using credit scores for a long time over the objections of myself and my fellow consumer advocates that it's not fair to penalize people for factors beyond their control if you're born into a household without credit. But credit scoring has been insurers have been insisting for decades that it's predictive and they're going to use it. And so, yeah, low income households have been struggling as the non-favored, in a for-profit system because of lots of factors, right? Because insurers are using credit scores, because they like to insure customers that have multiple assets. They often give the best rates to their affluent customers. So there's a lot of challenges we have. But I think, parametric products are really, I think, hold the most short-term potential to help households, their fixed dollar payouts for a specific loss. Now, they're not going to put the entire house back, where we're talking like $30,000, $40,000 that gets wired into your bank account if there was a disaster within a set geographic, radius of where you live. What I like about that as an advocate for the consumer is there's no fighting about whether the money's owed or not, and how much it's going to cost to fix. It's just, there's the money, right? So I like that, because in addition to insurers reacting to climate change and to all the data they have now that makes the risk look so much more vivid to them, the tech tools and inflation, it's increasingly clear that we've got to figure out a way to better balance who is going to bear the cost of the increased risk, right? Insurers are saying, well, we don't want to bear it. We know we don't want taxpayers to bear it. We know we want to keep the pooling, the pooling of diverse risks, the smart investing of the premiums people put in. And that's not rocket science. That's really what insurers do, right? They build a pool, they collect premiums, they invest it wisely, and then you buy extra protection in layers. So we've got the tools. We just have to recognize that we don't have a model yet that really is viable. Parametric is a start. The concept of a federal disaster insurance program, such as Adam Schiff has put in a concept. There's a number of other concepts. Great thinking, but because states regulate insurance, it's not regulated by the feds. We've got a lot of political challenges with trying to do something at the national level.
Yeah, maybe Carolyn, you could expound a little bit too. Amy, thank you. You brought up parametric insurance, but Carolyn, if there a little bit more on that, or if there are other new solutions on the table that could help, and is there a role for insurers and funders to play in that conversation? And there's just a question popped up too. I'm just going to add to it because I can take that privilege here as the moderator, with just even examples of nonprofit models of insurance and what that is looking like too. So
yeah, sure, happy to. I'd love to share some thoughts on parametric that Amy started to talk about. But on that first one, I will note, as Amy said, I've not seen many nonprofit insurers. I think it's a really interesting concept that should be explored. But we have seen some interesting conversations around what is this inherent conflict of interest at the heart of the insurance business model, right? Which is when the consumer needs them to pay out claims, every dollar of claims paid is a dollar less profit to the company. And that's problematic because that's the moment, right, when consumers really need their insurance company to be stepping up and paying them. And there was kind of tech startup called Lemonade that's now expanded quite a bit that took this to heart and tried to develop a new model where they put people in groups and you pick a charity. And after they've bought their reinsurance and made claims, if there's any extra money at the end of the year, they give it to the charity to try to get rid of that conflict, that it's not going to be part of their bottom line profit. So I think we're in the early days of thinking about some of these new models, but also we could look to things like captives and mutuals. You know, there's long been insurance companies that are owned by the policyholders themselves. So I think, yeah, whole interesting conversation. We could kind of go down a rabbit hole there. Let me pivot though and also say a quick word about parametrics. And I want to kind of maybe note at the top that, you know, everyone, myself included, would love there to be some silver bullet solution to the crisis that we're seeing. And I just really don't think there is one. I think it's going to be a patchwork of things that are right in different places for different populations, coupled to the like really hard work of risk reduction and improving climate justice, right? So that said, as we were talking about, there's lots of gaps that still exist in our disaster safety net right now. And our current programs, including homeowners insurance and the federal flood insurance program, and also our disaster aid programs like through HUD and FEMA, are all really important and playing important roles, but there's still different types of people and needs that are not met, and people still can really struggle to recover from disaster events. And so we need this expanded toolbox of approaches. And I think that's where some of these parametric models come in. They do not replace standard homeowners insurance, which you need to be an indemnity product and cover a bunch of perils, but they do help us start to fill a bunch of other needs. So my work on this started when we designed and launched, I think, the first use of a parametric rainfall product in the US to support emergency needs of low-income households in New York. So this was a National Science Foundation grant that we got that I was PI on, and we worked with the Mayor's Office of Climate and Environmental Justice, they had a different name at the time, and the Center for New York City Neighborhoods to first do that assessment of like, what are the unmet needs of residents of New York City? And what we focused on was what I mentioned earlier, is those immediate costs that hit right when the disaster happens. And what we saw through some survey research is that those immediate costs can be handled by more affluent homeowners. They have liquid savings. They can run up their credit card and know that they have money coming, even if it's months away, to kind of pay it off. But lower income families were engaging in coping strategies that produce sort of longer term costs for them, like not being able to pay their rent or bills, or taking medical, you know, dollars for healthcare to pay their disaster costs. So what we wanted to focus on was those immediate needs where other programs weren't providing dollars fast enough. And focus on rainfall flooding, because that's getting worse in New York City and the Mid-Atlantic region where I am. And the flood insurance program had been working pretty well in coastal areas of New York, but in rainfall related areas, people weren't told they were at risk, didn't know they were at risk, weren't insured, couldn't afford an NFIP policy if they wanted one. So what we ended up doing was designing this parametric rainfall product. And I will note that parametrics around rainfall still difficult. There's not easy triggers to release payment like there is for something like hurricane wind. But the Center for New York City Neighborhoods bought this product, working with their broker, Guy Carpenter from Swiss Re, and it pays out when an extreme rainfall event happens in one of their neighborhoods. And then they use that money to finance an immediate emergency assistance program that they stood up. And they're really trying to think differently about disaster philanthropy, because this is an emergency assistance program. But what they're trying to do is get philanthropic dollars to pay the premium so that when the disaster hits, they immediately go to work and immediately have the money. Let me just say one other quick thing, because I think what I took as most interesting from this pilot, which is now in its second year, was one, you know, the model we developed, but that might have more limited applicability. But I think what has broader applicability is the process we used, which we refer to in our report on this as research informed and community led, where we identify the needs and survey solutions and what would work in this context. And so we're now working with several other communities on this process of identifying their needs and what type of solution can help fill them. And I think, you know, you asked about funders, that's a process I think that they could help support, because we don't have off-the-shelf solutions right now, and maybe ever. It's a process that is quite time-consuming of understanding these markets and engaging with them and figuring out how to make them work and what the right tool is for the right population.
Thank you for that. I think, Amy, I'm going to ask you one more question, and then we're going to go to audience questions and some that we received ahead of time from those who registered. So just would love to hear you, Amy, talk about the wildfire risk reduction and asset protection project that you're working on in California, And how does that reduce risk for insurance companies and for those homeowners and individuals that you're working with?
Thank you, Carrie. Yeah, I'm pretty proud of this part of our work, because when there was an event that happened, I think 2016, there was media coverage of there being 120 million dead trees along the spine of the Sierra Nevada mountain range. And people in the foothills of those mountains started getting dropped by their insurers. And my organization brought some of our resources to help people. We have, what do you do when you're dropped and how do you shop and all that. But the governor of California formed a task force, tree mortality task force, and it very quickly sprung an insurance working group. And I was part of that. And we had a lot of the fire departments from a lot of the rural areas participating, along with the Institute for Home and Business Safety and the California Department of Insurance. So we had all these interesting stakeholders there and insurance executives talking about it. And the insurers are talking, well, the risk is higher. And I thought, okay, so if they're saying the risk is higher and that's why they're dropping people, let's do everything we can to reduce the risk. And learning from these rural fire departments, they would say, well, yeah, when I run into Mrs. So-and-so in the supermarket, she would tell me she got dropped by her insurance company. Could I help her? So we would go out and we would look at her house and we would give her a prescription, do this, this, and this. We would give her, after she'd done it, and we would even sometimes help if she couldn't do it herself. We would help with limbing the trees and all that. Then we would give her a letter that she could use with her insurance company to say, my risk is reduced. And it was working to get a lot of people's non-renewals reversed. And the insurers would say, okay, great, we'll continue to insure you. So that gave us a germ of an idea. And when the guy who was running that insurance group retired to hang out with his grandchildren, one of the supervisors in the county said, hey, Amy, could you guys take this over and run this? And I said, oh, sure. We didn't have any funding for it, but I knew we could, because we've been around a long time and we have a lot of relationships, right? So we've been doing, now it's been about 4 years, we have a monthly meeting. And what we've been doing is we've succeeded over these years in establishing very clear steps and standards. These are the things you can do to reduce wildfire risk. We had to catch up to the states that have been doing that with hurricane and risk for years, Alabama and South Carolina and all that, in Florida, the My Safe Home, all those programs, telling people what, roof tie downs. But for wildfires, for a long time, people were saying there's nothing you can do. And we just don't accept, it's not true. There are a lot of things you can do. So the RAP working group is folks all over the state of California in different sectors. We've got scientists, we've got community activists, and everybody is sharing best practices and ideas. We floated a bond measure to get money to give household grants, right? In some of the more affluent counties, they're doing matching grants. In some of the counties where their households really cannot match, they just need the help financially straight up. Everybody's sharing ideas for how they are supporting risk reduction at the individual and community level. So we've gone and we're bringing insurers along as much as we can. And now, we separate from all the political debates over mandating insurance discounts, mandating that insurers renew the policy of somebody who's reduced risk. Those are all very hard fights, right? Mandates, very hard. Especially these days when insurers are pushing very hard for deregulation and more freedom to operate the way they need to in this environment. We're starting to see insurers really getting in with us to this endeavor and really feeling like, okay, they want, to a certain degree, they want to do the business. They don't want to leave. They're not excited about that. I've heard this so many times from State Farm folks. It's not that they want to leave or want to hit pause on new policies. They're just trying to keep their books in balance. And so now we're seeing, and our goal, Carrie, is to get insurance companies to compete for who offers the best mitigation support, who offers the best mitigation discount, and try to get them, from a marketing perspective, to use risk reduction as a carrot to really speed that up, because it's tough when a household is on a fixed income, asking them to spend money on fixing things that ain't broke, right? The roof seems okay. Why do I need a new roof? It's a very tough sell. So, it's still a lot of work to do, because even though IBHS unrolled their wildfire prepared home program, maybe over a year and a half ago, they still have only about, I'd say, under 300 homes in the state of California that have gotten that certification. So we're kind of trying to push for a little more flexibility, to reward people for doing something, and not punish them for not doing everything.
Great. Thank you both so much. We're going to move into a question and answer time. We have received several questions in advance, and I'm going to work through that list. And we also have some in the question and answer box from those of you who are attending live. As a reminder, the CDP webinars aim to provide education for the philanthropic community. So while we do welcome anyone to pose a question, we'll first focus on those addressing the funder issues. So I'm going to start with a question for both of you. So maybe Carolyn will have you start, and then Amy will have you also answer. And you've touched on this a little bit already, but what could funders do to fill gaps that exist for communities that are facing challenges in insurance coverage?
Yeah, it's a good question. And I think it's a hard question. There's not kind of like one easy answer, but I think there's a suite of things. As we've both been talking about, there needs to be more attention to managing risks at both a household and a community level. So we are luckily in a period right now where there's more federal dollars for that than there ever has been, but they are still not even close enough to meet the need and to meet the demand. And so that's both helping communities with their risk reduction investments, things like built infrastructure, green infrastructure, land use and planning, those types of things. And then also the household level measures, which are things like building to a fortified standard along the coast. So I think there's a suite of things around risk reduction. And I think insurers also have an important role to play in pushing those, as Amy was talking about. But then when it comes to insurance, we're up against, a rock and a hard place, which is that if the risk is so high that you can't afford the coverage, what do you do? And what do you do for populations that simply do not have enough disposable income to pay for it? And it's kind of what we've been struggling with in our inclusive insurance work, because you don't want to have to support forever the cost of premiums, but there are places where people are just never going to be able to afford them. So how can we think about what types of solutions we need philanthropic support for to jumpstart and catalyze, and then can carry forward on their own? And where are we going to need some sort of continued public sector or philanthropic role? For example, there's places that have been using parametric coverage for very low income populations in the global South that have been fully philanthropic or government funded indefinitely, right? Because there's just never going to be the income to support it. And I think we're still trying to figure that out and tease out where those different types of solutions can play when it comes to kind of the insurance crisis that we're seeing. But another role is also just helping think through and get more pilots going on some of these ideas that both Amy and I have been mentioning, because there's not much actually being tested on the ground. But until we test things on the ground, we can't sort of like learn and figure out what approaches can work where. And I'll just end on one thing. This isn't something for funders, but I just think it's really important, which is how do we bring the insurance sector into closer conversation with communities around actual land use decisions, right? Because there are places we're going to have to acknowledge are never going to be economically viable for long-term habitation anymore in the face of these growing risks. And so how do we start to identify where those areas are and find equitable ways to stop development in those places and get people out to safety while building safer in the places where we can have communities thriving in the much longer term?
Amy, anything to add to that? What funders can do in that space?
I mean, I think there's lots of opportunities, but I do think figuring out how to support mitigation grants is an important one. I really don't know that there's been much funder engagement there. It's been public money, which is great. But if we could, a lot of it is just, we would love to get more funding for our this RAP working group, because we have a RAP resource center, which is an online place where you can go and hit your county and you'll find out who's offering help for risk reduction. And I'd love to see something like that go beyond California. You know, there's a lot going on. There's a lot of resources, but I think what I love the most about our working group is that we're a connector to all these communities and the people that are in those communities working. And so, yeah, those are probably what I'd say is a good use of philanthropic dollars, is to support risk reduction at the individual and community level, to supplement some of what the federal and state governments are doing.
Carrie, I actually had one other thought. Can I jump in and add another one? Just building
Yeah,
on that.
absolutely.
What we've been hearing too around some of the risk reduction measures, and we've been hearing this primarily around like building to fortified standards along the Gulf Coast, but I don't know if maybe the same thing's coming up with wildfire standards on the West Coast, is that even if you get the money lined up and the awareness so that people have the dollars and know what they need to do, they have to find contractors and builders who know how to do it, and
Right.
especially in a post-disaster context. And we've heard that that's actually a real bottleneck right now. So I've heard many people now talk about the need for like job training programs and how do you get the workforce to be able to support resilient construction at a wide scale. And we've actually been talking about kind of linking these ideas of the resilient construction also with decarbonizing the building sector, so that if you're rebuilding, how do you rebuild to both a strong resilient standard, but also do all the things you need to start decarbonizing buildings as well. So that's one last idea.
That's great. Thank you. Carolyn, I think we'll start with the next one for you as well. So many of the things that you've mentioned, this is from the audience, require policy change. Yet we haven't seen much willingness to fund state and federal level policy advocacy for funders. Do you have ideas for how to move this forward? And then maybe after that, just to follow up, Carolyn, Amy, you mentioned some places where people were rolling up their sleeves and doing some of that work. Maybe you could complement that with some of those ways that you've seen some of that policy and advocacy work happening.
Yeah, well, I completely agree that we need a lot of really good policy advocacy work in this space, because our federal and state policies form the sort of architecture and framework in which all of this can happen. And we have some policies right now that are actually really hindering some of the important kind of climate adaptation and resilience work that we need to do. But for maybe 80% of, I think, the policy change that we need, it's already been really well scoped out. Like there's already been a lot of good research and analysis and program design. And the hurdle is really like actually just getting the legislative or regulatory change done, which is, again, yeah, just that advocacy role. I don't know how to motivate people to want to fund that. I do think it's important. I have been frustrated myself that there hasn't been more movement on some of these policy pieces, because this is a space where there tends to be, not always, but a lot more consensus across the political spectrum, right? Because keeping people safe from disasters is really not a left or right issue. That's like an everybody, America needs to be safe kind of issue. And so you would hope that we could find some solutions there. And I've also seen solutions put forward that kind of take pieces from both the right and the left. Like I think this concept that's been really well developed around a means tested assistance program for flood insurance is one such thing, where it's relying on sort of a market mechanism of insurance to kind of push recovery, send those price signals to the market, but also recognizing that there are households that really just do not have the ability to get that financial protection, and they're the ones that need it the most. So I would hope that we could get to that place of kind of getting some of that work done. And I will, on a more hopeful note, there have been some really positive policy change recently. So for example, 5 different states have improved their flood risk disclosure laws, which is really important public policy for making people aware of their risk, which I think is a nice example. And there's been a lot of federal agency reforms, like FEMA's been doing a heroic job in improving the equity in a lot of their programs and the accessibility to their dollars. So yeah, just to end on a point of hope.
Yeah, so as far as rolling up sleeves and who's doing good work, you know, in California, after the 1994 Northridge earthquake, the insurance industry kind of as a whole, as they often do, seem to function as a herd, said, earthquake is an uninsurable risk and we're getting out. And they went to the legislature and said that they were going to leave the state if they didn't, you know, get relieved of the obligation to include that coverage. So that the state formed the California Earthquake Authority. It is a nonprofit insurance entity. And I have worked for many years with the management there to try to fine tune their product and help them get a bigger market share of people being protected. And it's been a challenge. One of the things that they came up with was what would be really helpful would be if there was a federal reinsurance, like kind of a backstop. We have a model for that from with the Tourism Risk Insurance whatever, TRIA, that again, after 9/11, insurers said, we can't insure terrorism risk, too big for us. So the government created TRIA. In my travels, I go, I'm part of all the insurance commissioners, they meet 3 times a year, and I've been this official rep there now for many, many years. So I really have had a chance to talk to a lot of this, red, blue, purple states, and looking for consensus ideas. And it feels like this federal reinsurance backstop is probably something that we could do there's a lot of debate over the details, but just that in itself, that would have helped if we could have had that, or some sort of loan guarantee from the federal government that would allow an insurer of last resort to maybe make their policies more affordable because they wouldn't have to buy retail reinsurance. That I think is really, really got a lot of promise. There's also an example that we have of the municipal risk pools, where in the 90s, where a lot of cities and towns were losing their liability insurance. Again, we had a hard market like we have now, and they got together and said, we're just going to have to form our own risk pools. And now there's the very healthy, robust municipal risk pools. So we've got some models to look at. We're looking, at community-based risk pooling. Carolyn mentioned, I think Marsh and McLennan. They're really, yesterday, the Colorado Division of Insurance hosted an insurance forum, and they heard a whole presentation from Marsh about parametric and how that might help, because they're about to, they just had to make a fair plan there because their private market is not bringing enough options for people. So we've got some good work going on for sure.
Thank you. I think one more question here in the question and answer box, and maybe we'll start with you, Amy, on this one. Is the insurance industry influencing the policy question of whether to rebuild after disaster or to focus on retreat from high risk areas? I think we've touched on this a little bit in the conversation, but just would love to hear your thoughts on that question.
I don't know that they're influencing rebuilding as much as they're influencing buying. I mean, I know, for example, and again, to use California, the developers are lobbying very hard to raise the limits in our state plan. So because they say it's impeding their ability to build multi-unit housing. So we do have a tension between, wanting there to be housing and there, and us not wanting people to be developing in areas that are then going to be, that are vulnerable, to climate change. So I would say, certainly after disasters, there's always a very strong, we will rebuild, Nashville strong. And, that's how a lot of communities feel, is that like, we want to come back. I will say United Policyholders worked hard to lobby for legislation, and we've gotten it through in a couple states that allow people to cash out on their insurance without having to rebuild. So not leave money on the table. And it's a very practical law. I don't know that insurers have been really enthusiastic about it, to put it mildly, but I think they're beginning to, there's got to be some flexibility now with insurance executives. They've got to, understand not only that they should let people collect their max benefits and not rebuild if they were in harm's way. And I think that's going to spread. We've got it, I think, in about 4 states now.
I'll kind of pick up on that. I think that's an important first step, what Amy mentioned about being able to take your full claims payout and use it to go elsewhere, to buy somewhere else or build somewhere else. The difficulty, though, is that, as far as I understand, in most places where that's operating right now, someone else just comes in and buys the property. And so it doesn't actually stop development or society's risk level, because then you just have someone else who maybe didn't understand the risk as much, or a developer looking to kind of profit on the rebuilding. So we need to be able to couple it to some things like we do with our federal flood buyout programs, where when people are removed from that risky area, the land is turned into open space in perpetuity to like really keep that land out of development going forward. But, you know, those kind of coupling the insurance mechanism to finance people getting out of harm's way to like a public sector program that manages the land or a land trust has proved sort of institutionally incredibly challenging to kind of get those pieces together. I've heard, you know, too, to the point about like new development, right? I've heard some discussion about potential policies where before permitting new development, you have to get a climate assessment or a check on insurance prices, which I think is really interesting to kind of check, because the developer isn't going to own and have to pay the occupancy costs, right? So how do we make sure that we're not building in places that are going to become too unaffordable? And the difficulty we're seeing there too, though, is that insurance prices for this year, they do not price for future risk. Buildings stay around for decades. And so we need an understanding of where the risk is going and what that means for the cost of occupancy and the cost of insurance years into the future when we make those decisions of where to put our structures right now. And we do not have any good policy or market mechanisms to get that future risk signal into the long-term decisions that are made today.
Oh, there are so many other conversations and spaces where I would love to take our discussion today. And there are so many more questions, and there's some great resources as well in the question and answer box. But unfortunately, that's all the time we have today. And I just want to thank you, Amy and Carolyn, for your time. We're going to have a few closing remarks and next steps before we close out for the day. But we have some next steps for funders that will come up here on the slide. And one of those is, from the conversation, is to build and to think about building resilient housing. Whether you're building new affordable housing or retrofitting disaster damaged homes, make sure that the housing meets the most resilient standards and codes for disaster risks in your community. Bring together new potential partners. Funders have an important role to play as a connector. Meet with the insurance companies in your community and find out how to help them. Then do the same with local housing authority. Then add in the renters' rights groups, homeowners associations, chambers of commerce, local government, etc. Help facilitate those discussions to see what kinds of plans and initiatives might work in your community. And then look into new initiatives. Both Carolyn and Amy discussed some of the projects that they're involved in, and we've discussed some industry trends. If there's something that's of interest, learn more about it and see how you might get involved. Insurance is a complex thing. And so I would also just say that there are experts out there who are willing to provide some of that context and help you along the way. So don't be afraid to dig in and to ask those questions. CDP provides numerous resources to assist you in planning your disaster grant making. We have monthly newsletter full of information and regular blogs, including our weekly What We Are Watching blog that highlights disasters worldwide. CDP's staff team is always available to provide guidance. And if you need more in-depth assistance, we also provide various consulting services. You can find out more information about our work at disasterphilanthropy.org. In 2 weeks, we have a crisis webinar looking at the severe weather across the country. That will be on June 27th at 1 p.m. Eastern. And then next month on July 11th at 1 p.m. Eastern, please join us for a special conversation between Tiffany Benjamin, President of Humana Foundation and CDP's board chair, and Dr. Elon Kelman, author of Disaster by Choice, as they discuss why we should be removing the word natural from the phrase natural disasters. In order to respect everyone's time and to keep this to an hour, unfortunately, that's all the time that we have for today's webinar. I want to thank our co-sponsors and once again, thank Amy and Carolyn for taking the time to share their insights with us. Please take a moment to complete our post-webinar survey to let us know what you liked and what you would like to see in future webinars. It will pop up automatically when you exit the webinar. If you have questions or thoughts that were not addressed during today's webinar, you may email them to tanya.gulliver-garcia@disasterphilanthropy.org. Thank you very much and have a great afternoon.